So the outlook for growth and unemployment has improved. 6 months ago, we were expecting a shallow but long recession. Since then, energy prices have fallen substantially, and economic activity is holding up better than expected. So today, we are forecasting modest but positive growth and a much smaller increase in unemployment. We think inflation will fall quite sharply over the coming months, beginning with the April number, which will be released in 2 weeks' time. Energy prices have fallen from their peaks, and that will now start to come through as lower inflation. Food price inflation should ease too, though we can be less sure about this on timing. But let me be clear, inflation remains too high, and it's our job to get it all the way down to the 2% target and have it stay there. And this is why today we've increased bank rate by 0.25 percentage points to 4.5%. Low and stable inflation is the foundation of a healthy economy, and we have to stay the course to make sure inflation falls all the way back to the 2% target. In the monetary policy report we present today, we've revised up our projections for growth in the UK economy. In the central projection shown in chart 1 here, the UK economy grows at a moderate pace over the next 3 years, with calendar year growth expected to be 0.25% this year and 0.75% in 2024 and 2025. Now, this is not a strong forecast, and we still expect a degree of economic slack to emerge from the end of this year. But the growth outlook is less weak than in the MPC's recent projections. Recent survey evidence supports this upward revision. Consumer confidence, though still weak, is at its highest level for over a year. In the March edition of the bank's NMG survey, households were more optimistic about the general economic situation than in the previous survey done last September. And the bank's network of agents has reported that activity has been stronger recently than their contacts had previously expected. Now, above all, the improvement in the outlook reflects a further fall in wholesale gas prices, reversing some of the terms of trade shock that has been the primary cause of falling real incomes. But there has also been greater resilience in the economy than we had expected, as seen, for example, in strong employment numbers. Fiscal policy is also expected to boost GDP over the forecast, building to a peak impact of around 0.5%. Both the temporary 100% capital allowances for qualifying business investment and measures aimed at increasing labour market participation are assumed to have positive effects on potential supply.